listening to Tech Reads, interviews with emerging technology thought leaders. Our sponsor is SoftTech, the premier technology trade association that has been serving northern Santa Barbara and San Luis Obispo County since 1997. Our mission is to create SoftTech moments where people connect, explore ideas, and create new business opportunities. Learn more at softec.org.
Hello, everyone. This is Brian Schwartz from Tech Reads, the podcasts for SoftTech, nonprofit based here in San Luis Obispo. Our mission is to bring people together. Today, we have Doug Garland joining us remotely, and our featured guest is Steve Selengut. How do you say that?
Selengut, just like it's spelled.
All right, Selengut. And he's the first time I've had an investment financial guy on the podcast. And since the topic was of interest to me, I thought it might be of interest to some of our listeners as well. Maybe, Doug, just quickly introduce yourself, and then we'll let Steve introduce himself.
I'm Doug Garland. I live in Shell Beach. I've been here 10 years. I'm a retired orthopedic surgeon from California. And I wrote a book with Brian, The Tall Poppy Syndrome, since I've been here. And now I have a blog that I do weekly regarding the Tall Poppy Syndrome.
Okay. And Steve, introduce yourself, please.
Steve Selengut. I'm living now in near Kiowa Island in South Carolina. I was a private portfolio manager for about 45 years. When I sold my business in 23, I had about 140 clients, some of them out of the country, most of them in, about 110 million under direct management. And I was focused on income development for these people, because most of them started with me and were with me for a long time. And we went from being young people to ready for retirement to retirement. And I saw my job as making sure they had enough income to, occasionally come with me on vacations and stuff like that, to really have more money than they needed to retire on. That's the focus. And that's the focus of the book I wrote after retiring. And I've now become an income coach, where I provide the income independence creating technology. It can be considered technology, I'm sure, to personal portfolios so that people can become financially, or if not financially independent, at least income independent. So that's where I am and what I'm doing. And
that's true freedom, where income is coming in despite you having to work for it. It's unearned income. Do you use that term?
No, I don't think of it as unearned at all. Not with the amount of thinking and thought and work that I go into creating my portfolio universes, selection universes and vetting securities and so on. There is work involved.
For your recipient, isn't there a tax classification for unearned income?
There is, and that is anything that is not from labor, not from a boss,
right.
So yes, and for the tax purposes, it's called unearned income, and I've always been insulted by that.
Well, and I see it as the dream, though, because if the only income you get is when you're trading your time and energy for it, that's right. If you love what you do, and you're like my dad, he's 82, he still works full time. Doug pushed it to the end, a long career as well. He loved what he did. His wife still works. And so some people choose to continue to do that, but they don't see it as work. But I think that's a small percentage of people.
Yeah, I can see why people call it passive income.
Yeah.
Certainly if you took my approach and left out a lot of the profit taking type stuff, mm-hmm. It could be a passive venture, and it could be successful, but not as successful as if you're using all the capital gains techniques as well.
So right over here, Janet. Good news, we have a new guest.
Okay.
Janet, why don't you introduce yourself?
Hi, I'm Janet Martinez. I live in Pismo Beach.
We have Doug Garland joining us from Shell Beach on Zoom, and Steve Selengut, who is the featured guest.
Oh, pleased to meet you.
I'm also from very near a beach too. I'm only a couple miles from the beach. So,
Just the
great.
other beach.
so the other beach, the Atlantic
Okay.
beach.
Oh, wow.
So Janet, what we do is we record these and put them out as a podcast. So
Okay.
this will be shared later. So anything you missed today, you can listen. And the whole intent is to ask Steve some questions that reveal some answers for you, specifically around the financial planning aspect of life. What I would like to open with is, why is it in your mind such a taboo subject in American culture? And I'm saying within families, within marriages, it seems to be a topic that we just don't talk openly about.
It's very true. I've never understood that myself. I mean, I love to talk about it. I've spent so much time doing it, but it's a big decision for a person to come to somebody like me as a, as an entrepreneur, as an ordinary employee, having a business or working for someone else to, make that phone call and say, hey, I need help with my investments. It's not cheap to hire a guy like me to run your portfolio for you. So I can see there's that. And then there's the possibility that somebody's going to say, oh, you're so stupid. Look what you've done. You've got this problem and that problem. And we know how to do it so much better. I've never been a we. So, and I've always tried to understand that nobody gets any financial education. I didn't get any financial education until I got
Financial literacy is a problem in this country.
Absolutely. A serious, serious problem. I mean, most people get out of high school, they can't even balance a checkbook. It's that bad. So, and if I hadn't been a business major and taken investment courses, I probably wouldn't have been where I am today in this business. But there's also the other problem of, I had another advantage that most people in my circle of friends and so forth didn't have, and that was that I guess I selected my parents better than most people have the opportunity to do, and I was fortunate that I could focus on making my money work for me instead of repaying debt for colleges and things like that. So I came to this effort with a lot of advantages.
When you say you selected your parents, you mean financial guidance.
Yeah, right? They took care of me real well, getting me through college. I didn't have any debt. I didn't have any problems. I pretty much had a choice of where I wanted to go for an education, all that kind of stuff.
Got it.
So very, very lucky, and not everybody's that fortunate. And I think in creating the business that I created and in the books that I've written, I have taken that into account, and I've tried to not to dumb it down, but to provide the basic understandings that you really need to have to become an investor. People today grow up and the only investment they have is a 401k, and they have selection, they have choices, and some of the choices are a little vague and what's really inside, and most people don't really care. And you find people that when I say, a municipal bond, they say, huh? Or if I say, well, that's a bond portfolio and this is an equity portfolio, you get a lot of blank looks because people they don't know how a corporation funds its operations and the difference between the ownership element in a common stock versus the debt element in a bond. And they don't know the difference between financial risk and market risk. What do they hear about? All they ever hear about is market risk, and Wall Street makes such a fuss about the ups and downs of the Dow or the S&P, and lately in the NASDAQ. These are numbers that are always going up and down. It's not a matter.
They're meaningless to the vast majority of us. I've heard a crazy statistic that, that's how they lead the news. The Dow was up today, the Dow was down, the NASDAQ is like, they talk about this, but apparently there's only 10% of the country that actually applies to, because 10% of the country actually has investments in the stock market that are considerable. I don't know if that's a inaccurate.
I think it is, because I don't think it takes into account managed programs, IRAs, and 401ks. Because everybody who's in a 401k is in the stock market.
Got it. Okay.
So,
but when you hear those numbers spouted out by the news,
right?
How many of us are actually like directly impacted by the swings that's happening in the market?
Right. Like I get that all the time. Like when they tell you today that the Dow is up 120 points, they're not telling you that both the NASDAQ and the S&P are down similarly. Mm-hmm. You know, so and if you don't know the differences and what's inside these particular averages, it's really meaningless to you. So I boil it down to the basics in the book. I mean, I talk about bonds. I talk about risk. I have a risk pyramid in there where I show people that this stuff here on the bottom, this foundation of the pyramid, is all, you know, corporate debt securities, government debt securities, municipal securities, and so on. These are things that the risk of actual financial loss is very, very slight. Whereas at the top of the pyramid, where you have things that are master limited partnerships or, Pacific Rim stocks of
speculative,
they're more speculative, and people don't realize when they go out and when they see these guys on the news at the bell where they're introducing their new IPO, they don't realize that 70 to 80% of those IPOs, that's it.
Well, I remember the emerging markets funds that we went into, because they had like a 20% return like the year before, and you're like, well, that's where I want to go, right? They had one or two good years, and those wind up being the duds, because you have no really knowledge about what's going on overseas, you know, in Europe or
But
why invest in something you know nothing about?
Right. But even a bigger problem is that they think all they hear about is the market's up today and this is good. Everybody's happy. The market's down. Everybody's sad, and so on. When there is no good and bad. That's what the market is. It's a market. You know, people are buying and selling. There's supply and demand at work here. It's all economics, and not many people have a background that can really appreciate it. Like I in Retirement Money Secrets, I point out that part of investment portfolio management is an appreciation that there is a market cycle, and there's not only a market cycle but an interest rate cycle, and all of the various sectors within the market, their prices have a cycle that's dependent on so many variables that prediction is impossible. But it's normal also, and you don't have to fear it. You've got to make corrections every bit of as good a friend as rallies are, you know, and that's only 95% true. There's a whole lot more fun taking profits than there is adding to investments when they're down, but both are necessary, and both are features, both are activities that you have to learn to put into operation if you're going to be successful as an investor.
So let's talk about what is kind of unique about your book, and you really dive into this idea of CEFs, or closed-end funds, which is a new concept to me. And you and I were talking before the recording, was that there's not a lot of commissions in there for financial planners. So there's a reason why we haven't heard about them, or why they're not recommending them. So maybe talk a little about what's unique about your strategy.
Well, there's not a lot of, they are trust vehicles. That's their composition. Just like all of us have maybe a trust for our families for the future and stuff like that. In a trust vehicle, the managers of this enterprise, this trust, they have to pay out 95% of the income they produce to the shareholders. And because of that, they only have 5% left to reinvest, unlike a corporation such as NVIDIA or Amazon can reinvest every penny of profits, because they really don't give anything to their shareholders at all, you know? So So the trust vehicle is not one for growth. It's not one to build market value. And since the end of the commission system that we used to have, financial professionals get paid on the amount of assets they have under management, AUM, assets or amount under management. Nothing to do with the income those assets produce. So their focus, and it's not necessarily the individuals themselves, but the people who own the companies that they work for, who are focused totally on the market value of their securities. And here at little old me, I'm focused on the income produced by the securities. I couldn't care less. I vetted these things for quality. I know I'm diversified properly. I know I'm producing all kinds of income. I really get as much kick and as much pleasure out of market values going down as I do market values going up. And I can take advantage. And that's one of the key elements that are described in my book. You have to be in a position to take advantage of the market cycle. You have to be able to take advantage of the market cycle, which means you're taking profits when things are going up. You're adding to positions and starting new positions when the prices are going down. And you're going to, and the question obviously now is, where do you get the money to take advantage of the downward portion? And you get that from the income that your portfolio produces.
So, the big $1 million question is, how much do I need and when can I retire? And, the 4% rule that I was familiar with, and you reminded me to kind of go back and look at that again, it's a little dated. And of course, with the inflation numbers being really out of whack, is maybe no longer accurate. But can you talk a little bit about, in an ideal world, how would you address that question?
Well, the 4%, the idea that you can live or could live on 4% of the value of your portfolios probably isn't a bad idea. It's how they go about putting it into operation that's really flawed. But if you think of it, if you have $2 million and you're going to take 4% a year out of that portfolio, it's going to last, at least 25 years, depending on how much growth there is. In down years, you're going to be taking out more dollars, but there's no income element. They're not thinking of the income. If you have $100,000 and it's paying 2.5%, 3% income, which is what most of you will look. If you look at your portfolios, that's what you're going to see. Less than 3% for most people. It's you're going to be only reducing the principal by the 1%, But in a down market, since you're only in a market value, 3% is less money to spend. So most of you are going to say you need more. Okay. And they have to take it from somewhere. So they have to sell assets to get you the money you want.
Right.
When I design a portfolio, I don't have any securities in my portfolios that pay less than 5 or 6%. So even if the market is down 25%, I've got enough cash to pay out more than 4% in there. So that's the one difference. But I have so much more than 4% that I can if the person can reinvest 60 or 70%, he's going to grow the assets that are the amount of capital invested in the assets that are producing the income, and the income is going to grow every year. And typically in a portfolio that's done my way, it'll grow faster than the rate of inflation. So it's a whole different way of looking at it. The problem is that I'm not paying any attention really to the market value except for two things. I use market value, the price of the securities, to determine the yield, so I know what I'm buying and why I'm buying it, and when I can take profits. Profits is not something that the average financial advisor is going to talk about. If you initiate it, he'll be happy to take profits for you. But for him to initiate it, he's taking a great deal of risk in a litigious society like we have. Let's say he sold your Microsoft at 120% profit. Okay.
Okay.
But the Microsoft then went up another 120%. He could sue you and collect something. You see it all the time. There's lawsuits and lawsuits against financial companies because of things like that. When I was managing my business, the clients had to sign a document when the management agreement said, I will be taking profits, and I will be taking profits regularly, and I will be taking profits on securities that will continue to go up, and so on. And sometime in the future, I'll probably buy those securities back again and do it again. But I will be taking profits. So if you're not ready for that, then don't sign up with me, because that's the way it is. There are two streams of income in the investments: the dividends and interest. In the closed-end fund space, we call them distributions because they're combined of many different things. That's the base income that you're going to get. And that's what you're going to try to make your portfolio produce no matter what the market is doing. If it goes down 50%, that income doesn't change. If it goes up 50%, it doesn't change. So that's the base income. The other source of income, the other stream of income that my methodology develops is the profits, the profit taking, the growth in actual capital. Just like I consider a portfolio the same as McDonald's considers its hamburger business, or Walmart considers its broad number of different products and services you can get there. You can get services if you sign up for them, everything's for sale all the time. The customer comes in, wants to buy some of your inventory, you sell it to them. I feel the same way about the securities I own. If I can get 5% profit on one of the closed-end funds I own, I sell it and I replace it with another one. It's just a matter of inventory. It's, if you read the book, The Income Factory, I don't know if he went as far as to say that all the securities he owns are interchangeable parts. That's how I view them. I don't like any of them more than others, although I recognize that I take profits more frequently on certain ones. But I love them all. They all are either producing at least 6% income and or the opportunity for profits. And it's a whole different way of looking at investing in the stock market.
So how are CEFs different than mutual funds? Or are they the same kind of?
They're similar in content. They're very, very similar. Okay. They will own pretty much the same securities. The equities will have hundreds of different equities in there. The bonds will similarly have hundreds of different bond issues from different companies and so on. The quality of the stuff inside will be similar.
Is there like Morningstar reports for them too, or not?
I think there are, but I never look at Morningstar because Morningstar is a market value focused entity. Okay. It determines how a stock or a bond or whatever performs, and performance means moving in market value, which again is not something I care about so much, and how that compares with others in the same area, the same sector, the same same structure. So if they do have Morningstar ratings, I don't look at them. Even when I was strictly in the stock market many years ago, I had the S&P guide. There was a monthly S&P guide that had a rating system as well, and kind of a competitor of Morningstar. But Morningstar is based more on technical, and the S&P guide was based on fundamentals. PE ratio, debt to equity ratio, profitability, whether or not it paid a dividend, all the things that meant a lot to me. So I would only buy things that were rated B+ and better by Standard & Poor's in individual stocks. So, so there's a lot of that has changed since S&P stopped doing that. And that's one of the catalysts for me going into closed-end funds full bore. I don't own any individual stocks anymore.
And then Doug, I want you to think about any questions you have as an active investor. Would you recommend, like, for people to fund these going as drastic as maybe like selling their house and using that money for something more? Like, we don't generally generate income from our homes. We just notice, unless you take a HELOC, right? And then you own less of your own home. I mean, if someone needs to shore up, so me as an example, we've been, I used to work for IBM, and thankfully they forced me to save a lot in 401ks, as you said, and now the IRAs. And it's not really where it needs to be. But if I look at the value of our home and what the equity we have in it, we're all of a sudden looking much better than we would have been. But we can't touch that money, and we're not in a position to generate income from it.
Right. You can't spend it. You can't spend that market value of that home right now. And now that interest rates have gone up, you don't want to take a homeowner's equity loan and then use that for investing, which is it's not like a margin loan. It's not as bad as that, but I did it in 3 or 4 years ago. I did it because, and I kept getting my mortgage down lower and lower by refinancing. And I borrowed money because I knew how much I could invest it for. And my income from it was far more than spending. And then there's other things you can do, like those where some of the banks will give you this opportunity to get a 0% loan to pay off other debt, but you can't use that credit card. Otherwise you pay 24%. It's one of those deals for a number of months. So I've done a couple of those because I knew I wouldn't have a problem not using it. But no, I would not sell a home. If you're planning on downsizing and you can go into even a rental property and keep several hundreds of thousands of dollars from the sale and put it into investments, yeah, it makes sense. But if you're just going to, I wouldn't do anything to change my lifestyle to do that,
I just want my investments to start paying me an income.
Well, that's what you have to do. You have to look inside and say, well, right now you got a perfect time to figure that out. The stock market is not at its all-time high anymore, but it's not a long way off. And the bond market, although prices have come up this past year, still way below where they were 5 years ago, way below. So if you have assets if you look in your account that's only paying 3%, and you've got a few hundred shares or thousands of shares of Microsoft or something else that you've owned a long time, it's paying you no income at all, you're at the perfect time in your life to say, okay, I love Microsoft. They've done real well for me. I'm going to sell that, and I'm going to buy a bunch of these things that pay me 10% right now because of where interest rates are. And there you go, problem solved. But I wouldn't be looking at my home to do that. I'd be looking at my investment package. And really, as a coach, that's what I do, because people come to me with these investment portfolios, and I look at them for what I call a QDI plus PT, risk minimization review. If you've read the book, so you know what I'm talking about, but you guys haven't probably. So I look at the quality of what they're in. I look at the diversification of their whole program. Do they have anything with more than 5% in one position? That type of thing. I look at the income being produced, and I look at the evidence of whether or not they've taken profits. And you can see that because you compare the market value with the cost basis of each item, and you can see most people never have taken a profit. They'll have 30, 40, 100% profits in certain securities that are paying them no income at all. And as they get older and older, this is the perfect time for them to say, okay, thank you very much. Now I want income. The thing about closed-end funds, which we didn't get finished with that, is they own everything that you could own if you owned individual securities. If you were to sell your Microsoft and still keep 20 or 30% of equities in your portfolio in the form of closed-end funds, you'd still own Microsoft. It's in there. All the popular ones, all the energy stocks will be in the energy-based closed-end fund. All the healthcare darlings will be in the healthcare ones, So that's what I say. I treat my portfolio like a giant store that has everything in it, maybe even a shopping center, at this time. But you're not missing out on anything by not having the individual stock. If you use the three different funds we talked about, closed-end funds, mutual funds, ETFs. The distinction I said before is the CEFs are focused on income generation. It's secondary or not considered at all in mutual funds and ETFs. They're there for market value growth. That's why they're the popular things in 401ks and with investment advisors, because they're designed to grow in market value. CEFs are designed to generate income. So two distinctions there. Okay. It's a lot easier to trade CEFs and ETFs than it is to trade mutual funds, which only are sold overnight. You can't sell them real time during the day. So that's another advantage. The primary advantage is the income. The average, I have 200 over 200 separate from my, and the tax exempts are really special, but the equity and income ones, the average yield on those securities is between 9 and 10% right now. Right now, and there's reasons for this that I could explain, but it'll take us a while. Municipal bond closed-end funds right now, I have a universe of 50 of those, and it's paying over 6%, tax-free. So, a lot of people with big incomes would find them extremely attractive right now. Okay.
Have you have any questions or comments?
I just wonder if you ever have a negative year.
A negative year in market value? Absolutely.
Income.
In income? No, I have never had one. No. Even in the account that I manage for myself, where I tend to spend almost as much as all the income sometimes, I still have enough in capital gains to build the capital to grow the income. So I would say for my client base, rarely, if ever, was there a situation where I wasn't able to grow the income. The only time is if a person has excessive withdrawals.
And in the world of 401ks and IRAs, we can't touch that money until what? We turn, is it 62 or 65?
I think 62 for 401ks. I think I just heard that in the conversation today. I'm not an accountant or anything.
A way for it seems silly, right, that we can't utilize any of our investments until we turn 62. Is closed-end funds outside of that restriction?
No, not if they're not going to be in the 401k, but in the IRA, they're just like any other security.
All right, so you still can't touch any of that income until you turn 62.
I'm not exactly sure of the law, like I said, but I think that's probably right. Whatever the law states, there are penalties if you take it out of a 401k early. I don't know.
Right. So, but your typical client is over 62, it sounds like.
Most of them. Most of my coaching clients certainly are, and my management clients at the time I left, yeah, they were all, some of them were older than me.
So
many of them.
What can we be doing if we're not 62 yet to prepare ourselves to be in a good position? The
only thing, and this is what I advise people to do with 401ks, is look at what's going on in the markets around you. When you see, and you should be able to determine from the offerings whether they're stock market based or bond market based. If they say income is part of the name, they probably have income securities in it. So what affects them most is expectations about the movement of interest rates, whereas the other ones, the majority of them, are equity based. So what you should expect to see, and what you probably notice, is the mutual funds or ETFs in your 401k reach very high levels when the stock market does. So when the stock market is a high level, and sometimes when the bond market, when interest rates are at zero, those are already up too. But now interest rates have gone from 0 to 5%. And even though they're up this year, they're still way, way below where they were when interest rates were lower. So they're pretty much of a bargain, more so than the equities. So if you've got a 401k and you see them at all-time highs, take some profits. Move some of that money from the equity closed-end funds to the income sector. If they're both up and you have a cash alternative that's in a money market fund at 5%, that takes some of the risk away too of losing it when the stock market falls. So you can use the market cycle to your advantage in managing your 401k. If you have some of them offer a brokerage account alternative where you can take some of the money and put in a brokered environment. If you can do that, then you can do anything you want with CEFs also.
Okay, that's good advice. That's good advice.
So,
Janet, did you have any specific questions for Steve?
No, not specifically. Mine is more like the international market of the dollar and the petrodollar being compromised with not renewing, Saudi Arabia not renewing the agreement. Is that going to affect?
I am totally void of any knowledge
Okay.
on monetary policies and changes in rates of that type of thing. No,
Okay.
I'm
Thank
sorry.
you. No.
I can't help you with that one.
Okay.
I don't think it's Saudi Arabia as much as it is Biden.
Not honoring the petrodollar.
Right.
Okay.
He's letting it because he's an environmentalist and he's letting it fall by the wayside because he doesn't believe in petrol.
Okay.
So that whole, if Trump were elected, that would probably change because he believes in oil, and it would be making America great again if we re-signed with the petrodollar. So it's an administration problem, I think, not Saudi Arabia's problem.
Hey,
and putting pressure on them.
Steve,
Okay.
is our CEFs on Robinhood?
I think so. I would guess so. I've never used Robinhood,
Got it.
but just the best place to go to research closed-end funds, and it's the one that I use almost exclusively, is a place called CEF Connect.
Okay.
And it's offered by Nuveen Securities. And actually something that you might be interested in, closed-end funds, the biggest producer of closed-end funds, the offerer, is BlackRock. BlackRock, Nuveen, Eaton Vance, Gabelli. I mean, a lot of familiar names in the investment environment are in the closed-end fund field as well.
My last question is around the impact of AI on our investments and telling us exactly what to do and following that advice from, we are seeing it impact so many things, Steve, and I don't know if you've been playing with it, but I would think that a CEF fund that has an AI management aspect to it would be a smart place to invest.
Well, there are CEFs that have AI companies as the securities they invest in. Having AI replace what's between your ears in investing, not a chance. I'm looking now to try to get my methodology into a place where it can be used by a big operator. And I can see where you could say, okay, you've got this portfolio filled with closed-end funds, and I've got a maximum that I use, a maximum of 5% profit. If it gets that far, I'm going to take it. But do you take everyone? What if we have a 2021 where 40% of your portfolio, 80 different securities, are over 5%? Do you take them and then try to replace them? And how quickly can you do that? The amount of money that's going to be idle is, So it's got to be something that you got to be able to adjust the parameters. When the market is down and everything is down and you see the yields are growing because the prices are down, not because anything changes in quality, but you don't have as many profits. You've taken the profits and now you've got a situation where it makes sense to take a profit of as little as 0.75% because you free up in a big, let's say a big portfolio, you free up $1 million of capital that you can then reinvest to increase the yields and reduce the cost of other securities in the portfolio. Are you going to let a machine do that? I don't know. I don't know.
Well,
I'm not ready for it, but
I read an interesting article where somebody took all of the financial, like the quarterly reports from a corporation and like used AI to essentially help tell it which company should I be investing in. And it did a really good, like a better job of a lot of fund managers is what.
But what is it trying to do? It's trying to predict the future.
Right.
So what happens if we have some more jets flying into office buildings in New York or into buildings in Washington? Is that AI going to be helpful? Not at all. But your head is going to be helpful because I knew a 9/11 was an investment opportunity. I was crying out of one side and investing out of the other because that was my job, right? Hey, people, prices are down. I'm going to invest your money and get good bargains. You cannot predict the future. Technology is used to such an extent in the marketplaces and decision making. That's why I don't have any hair up here because I've been pulling it out for years. Fundamentals are more predictive. Knowing that this company is profitable and that it's paying me a dividend is more important than what somebody thinks the Z-score or some other technology thing means that it's going to go up for another 3.5 weeks and then it might go down. I mean, really, please. Technology is fun, but in the world of the investment markets, we've got a world to consider. We've got what's China doing today? What's going on in the Middle East? What is Putin doing tomorrow? Every action taken by any of these, you've all seen how it can affect the stock market. The job of you as the custodian of your assets is to try to create a portfolio that is somewhat immune to that, where you're going to get your income. You're going to have your income independence irrespective of what goes on in the world, irrespective of a 9/11 or a war in Europe or stuff like that. For the most part, you didn't see any corporations cutting their dividends, but the stock market went kaboom and it was an opportunity. That's what you want to have. You want to have this immunity, this type of feeling of self-confidence in the companies or the funds that are paying you money, that's not going to stop regardless of what goes on with the stock market or interest rates. And I think for the most part, the retirement, the system that I describe in Retirement Money Secrets gets you close to that. There's no guarantees. There's always individual decision-making involved, but the basic philosophy, the basic idea of, and you can see it when you look at these funds and you look at their dividend history, how stable it is, how stable it is, how stable it is. It works. It works.
Yeah.
Yes, you will lose money. Yes, you will lose money occasionally in any investment, but so much less frequency when you're in funds of this nature than if you're trying to pick and hold and buy and sell individual equities.
So what does the typical engagement look like with someone like you, Steve? Do you because typically with our financial planners, they are under some umbrella like Cambridge or, one of these big American Express companies that sort of are responsible for all of your holdings. But
Okay.
you are more like an independent,
Well,
like,
I was an independent when I was a financial advisor
okay,
also. And I worked through a broker, and the independent brokers are their compliance departments and everything is taken over by these big companies that own this guy, but they let them do their own thing. Like I was able to run income focused portfolios, whereas the people now in my old company are being told that they have to have model portfolios to offer to their clients as well, which I wouldn't even think about, you know. But I don't know. With what I do now as a coach, I'm looking at what your financial advisor has set up for you,
okay,
and I'm looking at it. Is everything of the same quality? Do I understand what you're in? There's sometimes I look at a portfolio, I have no idea what this investment is, you know, and I got to look it up. That's not a good thing because if I don't know what it is, you don't know what it is, you know, where there are strange things in there or so I look for the quality of things. Do I know that company's name? You know, does it pay a dividend? I can look, there's a column there. It says if it has any yield. If they're all zero yield, you know, quality to me is a company that respects my ownership and pays me a dividend. You know, that's part of it. So there's quality, the diversification in the portfolio is up to you as the manager. The income production, you have to set parameters. I will not buy a closed-end fund that pays less than 5 or 6%, depending on whether it's equity or income. And that's it. I just won't do it because I've never
so
had to. There's
what's
so many of them.
what's the commitment for the investor typically? Like, how much time are they putting into being more actively involved in their
Right.
investments?
The longer, one of the things is the biggest problem, I think, is with people who still have full-time jobs, you know, because they can't do what I do. I mean, I look at my portfolio every night after the market closes and I make all my investment decisions. And it takes me between, you know, if I start at 4:05, I'm done a quarter of five. But still, I've been doing this for 50 years. You know, the average guy isn't going to be able to do it as quickly as I do. So it's going to be a learning process. It's going to be a few hours initially, and it's going to be easier and easier as he goes along and as he trusts it. Um, but yeah, I think people can do it themselves if they can devote the time. If they can do it themselves, but and if they don't have enough time, they're not going to get the full benefit of profit taking because they're going to miss some. But they're still going to get the income can be set up, and you can just reinvest the annual, you know, the monthly dividends because there's a lot of money to be taken care of at least once a month, and that's not a whole big time consuming thing. So yeah, I think they can do it. Um, if not, they can try to convince their private managers to start developing an income portfolio for them. Most of them will say, no, we can't do that. The big operators won't even go near it. I could mention names, but I don't think I should. Um, you know, if they don't do it themselves, I have, I have people, my old firm and a couple others that are running portfolios my way. And, you know, I could refer them, but that's the alternative. And some of them will do that where they'll take care of, I mean, I've been looking at some big portfolios and the guy will say, well, I feel comfortable with this 2 million, but the rest of it, I think I want a manager with, you know, can you help me with that? You know, but yeah, I think the average guy can become proficient enough to do it himself and not miss a whole lot of opportunities. But the most important things, it's easy to learn how to stay out of trouble. It's easy to determine if you're not properly diversified. It's easy to see when you're not taking a profit because the big green letters on your statement are telling you, you know, this thing is up $4,000, dummy, take the profit, you know? So it's easy to do that and you don't have to do it every day to really be competent and take charge. Maximizing, no, you got to spend the time. but getting a whole lot better than what you're getting now with the 3% you're getting on your managed portfolio. You can do better.
Excellent. So any other questions before I have Steve kind of close it out with his little pitch on what he does and how people work with him? Anything, Doug?
Well, I like it a lot. He's like rich man, poor man, only instead of houses, he's used the market to do it, which I think is interesting. But to his last point, I mean, I'm retired 10 years now and I manage my portfolio much better than I did when I was working because you don't have time.
Right.
And you make a decision, it's going to be emotional based because time, you already have your mind on something else. So you can't think it through and you just make an emotional decision. And the other thing I would point out, which for you, if you do your 30 to 45 minutes a day, but you're always thinking it. So you're actually doing it during the day, even though you're not doing that focused 30 to 45 minutes. Kurt Vonnegut, a guy wanted to learn how to write. So everybody wants to know how a writer writes. So finally this guy gets to interview with him and he's thinking he's going to tell him, well, I go in my office at 2 a.m. and kick it out after four hours and I'm off. And he says, well, how do you write? So he can't wait. He gets his opening. He says, and how do you write? And he says, well, I'm writing right now. So that's kind of
that's
you're
really
living.
true. That's
Yeah,
really
you're
true.
living your life because you're writing right now, but you focus at a short period of time, and it's much more difficult to do while you're working.
Yeah, I check in several times a day to see what the market's doing, obviously. And the thing in the evening is to prepare my orders for the next day, but then I have to place those orders in the morning, or throughout the day. So, yes, to really do it well, it's a couple hours a day.
Yeah.
But you can do it adequately as you understand it in less time. Like the emotional part that you talked about. That's a big problem with most individual investors, where they get attached to something that's performed well in the sense of it going up. And they think that, they're not going to be able to do that again. They're not going to get another winner like this one, like this Microsoft or Amazon has been for me. It's been so good. What am I going to do without it? But then when they get introduced to the closed-end fund aspect, and they say, I still own my Microsoft. I just can't see it individually, but I know it's there, that makes it a little easier for them. And I give them so many different tests of quality and how to diversify and all this stuff. And these closed-end funds, of course, do a lot of that for you because there's so many securities inside. So it's one of those things, after you learn it, it's I have people who want to use an advisor for a couple of years until they actually retire. In the meantime, they're learning the process. Some of them are still coming coaching because they have questions all the time, stuff like that. So yeah, it can be done.
Well, it's nice to have someone to turn to rise above the noise because it's such a complicated beast. And I think that's why a lot of us, financial literacy it's not like reading literacy that we can understand and most people can grasp. But I think financial literacy is the reason why. I mean, there's different levels, obviously, but it's partially probably not taught because it's a very complex beast. I mean, maybe if you're an econ major, you have more financial literacy than the average Joe. But I wonder if a big part of it is, I was mentioning earlier, I just think that we fear what we don't understand because our brain wants to grasp something. And maybe with you, it's like, okay, the coach, same reason people hire me with publishing is like, it's a very uncertain world out there. There's the more you look into it, the more confused you get. And so they eventually come to me and they say, just tell me what I need to know. And so I don't make any stupid mistakes. And especially when you're talking about your finances and your savings, the fear of God is making a bad choice that will ultimately be so painful because you hear the horror stories, right? Where people finally jumped into something, but they jumped in too late and they lost everything.
Or they jumped in too big. But so the idea of risk minimization is so important, and how you do that. And you can see from what I've been saying, that the fear of an Enron type situation. Now, so Enron is one of 250 stocks owned in this one managed account. It's just like at the time, I was still doing mostly individual stocks, and my wife had 100 or 200 shares of Enron in her IRA, but it represented less than 1% or less than 2% of the portfolio. So it's like getting stung by a bee, it's not a life-changing event. And so many people have so much money tied up in one security.
Bitcoin, right? Put all your money in Bitcoin. You could double it if you bought it in the beginning of this year.
Yeah, you could have. And then you could have lost it all in the previous year. I don't know. I've never had any. I know there are some ETFs now. I haven't come across a closed-end fund yet that does Bitcoin, but I wouldn't be surprised if there are some out there. And they'd be new. And I don't do any investing unless the company's 5 years old, unless the fund is 5 years old.
All right, Steve, why don't you tell us quickly how people can get a hold of you and what you recommend is, if someone wants to work with you.
I think the ideal customer for me, or a client for me, would be someone who has read the book, has questions, but realizes that they could make some changes to make their life more comfortable. And I can coach them in getting them to that position where they feel comfortable. And I have coaching arrangements that go from a retainer for a whole year to just, a couple sessions. And I do Q&As. I can do a Q&A for a family business or something, various types of things. And I also can provide selection universes that I vet for myself with all those securities. I said I have 200 and some that I use. I have them in separate universes that I don't give them away, but I can get them.
When you say universes, I'm not familiar with what you mean.
It's a selection universe. I list all the equity closed-end funds, and I provide their distribution histories over the past years. So if somebody can see how much they were paying last year at this time, how much they're paying now, how many times they raised their distribution or lowered it, how stable, the stability of it.
Got it.
So I've vetted them all. I own them all. I can legitimately tell people, hey, there's nothing here that I don't own. So if I use it, you can determine whether you think you want to use it. That's about it. And I had that same premise when I managed money for other people. I told them I would never put them in anything that I didn't have myself. And I never did. So, I have that. But the book is to understand the difference between income focus and market value focus is really the key element. You got to be comfortable with knowing that the market just goes up and down, and that's it, man. Nobody's ever going to be doing anything about it. You just have to learn how to take advantage of both directions. Okay, so read the book, and I have a website that's called theincomecoach.net, which identifies all the services I provide.
Well, thank you for taking the time with us. Janet and Doug, thank you for joining me today on the interview with Steve. And until the next Tech Reads, I hope you guys enjoyed this episode, and we'll always bring in new and dynamic speakers on different topics, and hopefully you learn something and expand your universe.
Thank you for listening to Tech Reads, sponsored by SoftTech. If you enjoyed today's show, please subscribe and share it with your colleagues. If you have comments, questions, or want to suggest an author for a future episode, visit SoftTech at softec.org and click on the Tech Reads link.